I'm Max Keiser, and welcome to On the Edge. Time now to go to New York and speak with Dr. Michael Hudson, author of Super Imperialism and Other Works. Dr. Michael Hudson, welcome to On the Edge.
Thank you very much, Max.
All right, Dr. Michael Hudson, as we gear up for the elections of 2012 in the United States, we hear all the time that Barack Obama is A, Marxist, B, socialist, C, communist, D, Nazi. Now, you're an economic historian. Is the president any of these?
Mr. Obama's a Republican. He believes that it's necessary to cut back Social Security. He believes in balanced budgets. This is a Tea Party position.
All right, so Dr. Hudson, I mean, this just sounds like a complete repudiation of everything he ran on in 2008. So I can't think of a single campaign promise he ran on that he's kept except the one where he said he'd buy his kids a dog.
Well, I think you may be a bit confused, Max. He's kept all of his campaign promises to his campaign contributors. He's broken the promises to the people who voted for him, but that's the job of a politician. The job is to deliver your constituency to your campaign contributors. His campaign contributors were Wall Street, the same contributors who backed the Republicans and the Tea Party. So he's delivered his Democratic, liberal constituency, urban voters, minorities. He's delivered them to Wall Street. That was his promise to his contributors. He's kept it.
Okay, so let's roll back time for a second. We're in the first quarter of Barack Obama's presidency. He's got choices to make. He made a set of choices that have resulted in catastrophic economic failure. He could have made different choices. Number one, is that true? Could he have made different choices? And B, what are the two or three choices he could have made that would have put the economy and the country on a better and more sustainable path?
Well, could he have made different choices being Barack Obama, trained as a lawyer? He had a tunnel vision to begin with. That's what his backers wanted. Backers don't like to be surprised. They like to do a profile of the person, and they did a profile that he was very narrow-minded, tunnel-visioned. His thoughts were with Wall Street. He'd shown in Chicago that he will devote his career to real estate developers and their bankers. He tore down more black slums than any white person could have done on behalf of the Pritzker family and the Crown family and the University of Chicago that were part of the Chicago real estate redevelopment fraternity. He made billions of dollars in real estate fortunes for his backers. So given that mentality of we will back you for president, but you have to do what we say, bring Valerie Jarrett along, bring your wife along. We know where they stand. They stand with the financial and real estate interests. So in that sense, could he have really all of a sudden had a mental breakthrough and been what people believed? He promised change, and naturally his supporters thought from his book that the change was going to be to the left and to rescue the economy. His change was to move way to the right of the Democratic Party, even to the right of the Republicans. At the time he took over the presidency, the government was in control of Citibank. It was in control of the worst of the violators of the mortgage fraud experience. And essentially, Mr. Obama could have taken the opportunity to say, okay, we're going to write down the debts to the ability to pay, and Citibank and the other banks could have scaled back their mortgage loans to the current market rate of interest. He didn't do that. Instead, Mr. Obama appointed Tim Geithner as Treasury Secretary and said, what we're going to do is reinflate asset prices, reinflate the bubble to the point where it will save the banks from negative equity. He then agreed to give the banks all sorts of tax advantages so they won't have to pay taxes for years to come. He essentially did a giveaway from the real economy to the finance, insurance, and real estate, the FIRE sector, and that is what is pushing the economy into recession now. The problem is that Mr. Obama believes that we're not deep enough in recession. His policies are designed to lower wage levels and income levels in the United States by another 30%. His policy is to shrink GDP, to shrink national income by about 10% per year if he gets reelected. This is the Tea Party program. Now, the Tea Party people and the Republicans, I think, realize this, and so they're saying, we're going to help you, Mr. Obama. We're going to help you get your position through Congress and get reelected because we're going to move so far to the right that you're going to look reasonable by comparison. And, of course, Mr. Obama's compromise, looking reasonable, is to take over the basic Tea Party position.
Okay, so staying on this theme of 2008 and the choices that could have been made, we know that since 2008, the various bailouts and the subsidies and the giveaways from the government to the Wall Street banks has now started to rack up, and the number being floated currently is about $13 trillion. If you go back to 2008, every single mortgage in America, plus a big piece of all the credit card debt outstanding, if you added that all up, it's about $13 trillion. Is it true, Professor? I ask you as a student to the professor, is it possible that Barack Obama could have simply wiped clean every mortgage and credit card debt in the country, that is to say, bail out the debtors, instead of giving that $13 trillion to the creditors?
You're mixing a bit apples and oranges. The $13 trillion that we're talking about was the money that Obama's administration, with the Bush administration, had given to Wall Street altogether to cover its bad debts. It was $5.2 trillion was taking Fannie Mae and Freddie Mac, mortgage insurance agencies, onto the public balance sheet. He could have let them go under. The other $2 trillion was bailout by the Federal Reserve on the trash for cash swaps, letting banks give their junk mortgages and other securities to the Federal Reserve in exchange for deposit balances there and Treasury bonds. The other bailout was to AIG. For about $173 billion, to Citibank for over $50 billion. All of these bailouts were unnecessary. Citibank, there was a very interesting discussion between Sheila Bair, whose 5-year term ended last week, and New York Times reporter Joe Nocera. And Sheila Bair said, we could have wound down Citibank. All of the normal retail vanilla depositors easily could have been covered with Citibank assets. The people who wouldn't have been covered would have been the gamblers. And she said whenever she tried to do it, Treasury Secretary Geithner and Larry Summers would tell Obama, no, we have to save Citibank. We can't let Wall Street lose a single dollar. It was worth letting the economy and taxpayers lose $13 trillion just so Wall Street would not lose a dollar and would be permitted to continue to paying exorbitant salaries and bonuses to the bank managers who'd mismanaged the economy into the problem to begin with. Ms. Bair of the Federal Deposit Insurance Corporation said, all this is unnecessary. We could have kept the economy going, and the gamblers on derivatives trade, on bad gambles as to which way interest rates or exchange rates would go, all the gamblers, the casino capitalists, would have been wiped out in order to save finance capitalism and industrial capitalism. And instead, the casino capitalists took over and have done policies that are undercutting the real economy, and all this is unnecessary.
All right, now you refer to the banks as casino capitalism. Let's go back to the year 2000 and the Commodity Futures Modernization Act. Landmark piece of legislation came during the tail end of the Clinton years. Is it incorrect to say that this legislation effectively made legal gambling with derivatives? Because up until that point, a case could have been made that the way that the banks were creating and trafficking in the derivatives were gambling and would fall under gambling rules. The Commodity Futures Modernization Act took away that risk and opened the floodgates of what we can now know has become casino capitalism. Is that a fair statement?
It not only made this commodities gambling legal, it deregulated it. Now, the casino, so it's unfair to the Las Vegas casinos to draw a parallel because the Las Vegas casinos are pretty clearly regulated. You're not allowed to run a casino if you have a criminal background. You have to play fair. You have to open your books and keep honest accounting. The Commodity Futures Act was much less strict on gambling and derivatives than the laws governing casinos. So it was even worse than than opening the doors to casinos. The problem was not simply that it permitted banks to gamble the depositors' money on these derivatives and insurance companies, but that it deregulated them all and kept the regulators out because Alan Greenspan said, why would Wall Street people ever cheat their clients? That would be bad for business. Well, Wall Street must have laughed because they said, look, cheating the clients is good for business. That's how we make the money. Where would Countrywide be if it couldn't cheat the clients with junk mortgages? Where would Washington Mutual and IndyMac be if they couldn't cheat people? You have to have deregulation and dishonesty because that's where the really quick money is.
Is the Federal Reserve kind of the bankroller of this super casino model, number one? And number two, you mentioned Chicago earlier, and a lot of people, when Barack Obama was running, they talked about his community service in Chicago, but they didn't talk about the Chicago School of Economics, which of course gave us Milton Friedman. They gave us neoliberalism. It gave us this idea that markets are a god to be worshipped, and gave birth to this idea of what some call market fundamentalism. So can you give us kind of the historic frame for this?
The easiest way to think about this is the Chicago School of Economics, where General Pinochet called into Chile after the revolution there that overthrew, after the military takeover, and had him come in and essentially make a free market in Social Security and sell off the public enterprises. So the Chicago boys came in and said, here's how to do it. You simply turn you privatize the pensions, you turn all of the employee contributions over to a pension fund managed by the corporate employers. And what the corporate employers did was then put the pension fund money, lend to their industrial company, set up a bank to operate the whole conglomerate called a grupo, and then you bankrupt the pension fund by bankrupting the company and say, I'm sorry, we've wiped out the company and the pension fund, and we've kept all the money in the bank, but the workers are all wiped out. The Chicago School said, this is great. This is free market. This transfers funds from the poor to the rich. It essentially lets the criminals run society. So the Chicago School's idea of a free market is a market free. What is it free of? It's free of regulation. It's free of government prosecution. It's free for the people in control, the employers or the manufacturers, to manufacture without any product control. It's an economy free of environmental regulations. It's free of government, and it's free of taxation on wealth. And the Chicago School's basic principle is that of neoclassical economics. Any way of making wealth is as productive as any other way. It's value free, and the productivity is measured by how much income is generated in the short run. There's no long run. The short run is the long run. To the Chicago School, that's how financial markets operate. That's their time frame, basically. So essentially, by saying there's a free market, it's a market free of regulation, free of taxation, free of criminal prosecution. And they show this by mathematical models that are very tunnel visioned and essentially leave out of account all of the social consequences and economic consequences of economic polarization between creditors and debtors, between employers and employees, between rich and poor. And essentially, it's a very flattening of the economy to get rid of everything that classical economics was all about. So the Chicago School is the antithesis of what Adam Smith, David Ricardo, John Stuart Mill, and the 19th century progressive era advocated. Namely, you tax the unearned income, you bring prices in line with cost value. The Chicago School says there's no difference between price and value. We're talking about supply and demand, and there's no such thing as cost value that's ultimately reducible to the cost of labor. There's no free lunch. That's Milton Friedman's first claim. There's no free lunch. But you and I know that the economy's all about how to get a free lunch. That's what the financial sector is about. That's what the derivatives were all about. They were gambles. And when you're gambling with a government promising to make good all of your losses, what you call the moral hazard, then you don't have a hazard. The economy has a hazard, but if you're Citibank, you don't have any financial hazard at all because you told the government we're too big to fail, and we've made sure that you've put in place appointees that believe this Chicago School guff that you shouldn't regulate. You've appointed people like Alan Greenspan and Tim Geithner. You've appointed deregulators. So when Tim Geithner went before Congress and said, I am not a regulator, in his testimony and was approved by Congress, that's what they wanted, even though the job of the Treasury and the job of the Federal Reserve is supposed to be to regulate the economy. So the Chicago School says all regulation costs money. It doesn't work. It's the road to serfdom if there's any government regulation. And so what they have done is create an economy that runs into debt, and they've replaced the road to serfdom, the big government, with the road to debt serfdom to the banking and financial sector.
Right, and you've got millions of people in the states now that are being washed away from their homes because of flooding or burnt due to these out-of-control fires or suffering, climate or energy catastrophes because, as you say, neoliberalism applies no cost to...
Well, the suffering you're talking about does not appear in the Chicago School models.
That's right.
So essentially, you should look at the Chicago School as essentially censorship. They managed to get their school in charge of most of the journals that professors have to publish in order to get promoted. So many of our students at Kansas City, for instance, if they go to other universities, they are promoted from assistant professor to associate professor to professor by publishing in journals that are refereed by the Chicago School editors, so they won't permit any of the things that you're talking about and I'm talking about to be published in the journals. So the result is that economics itself is turned into a kind of tunnel vision.
Right, and to finance the tunnel vision requires hundreds of trillions of dollars worth of derivatives, which, of course, engender fees that go to these banks on Wall Street. We've got a couple of minutes left. I want to ask you about kind of an economic phenomenon and get your take on it. Across the United States, we're seeing waves of copper thefts. People are stealing fire hydrants, manhole covers, breaking into churches and stealing the lead out of the windows. Clearly, there's a huge demand for stuff, and yet Ben Bernanke says there's no inflation. How is that possible?
Well, I remember back during the Vietnam War, each soldier in Vietnam used 1 ton of copper per year. You'd think they were fighting each other with ingots over there, but that's how many bullets they would use. This pushed the price of copper up so high that people who had copper drain pipes, and copper was all drained then. You're having a similar position today, not because of a military war, but I guess you'd say because of the financial class war against the rest of society. That if you're going to impoverish the economy and leave people without jobs, they're going to scavenge around like they would in any third world country. And so the easiest way to make money is by dismantling property that's already in place. So here you have all of these metal fire hydrants, manhole covers that are already in place. You're having even the lead stripped from the churches, not only in America, but in Britain. It used to be that the churches in Britain had lead roofs because, as it happened, the lead mines in Britain had a lot of silver in them. So lead roofs used to be stolen for the silver. Now the lead roofs are being stolen from churches all over the world just for the lead. that shows you what a desperate shift there's been towards the stifling the real economy that produces actual goods and services. The Chicago School says one way of making money is as good as another way. So there's no difference between making commodities or real things or making money by making loans or going to Las Vegas and running a casino. If you have that kind of commodity idea, then it's going to be easier to make money quickly by stripping assets rather than by creating production.
Okay, I really want this analogy to the Vietnam War and the copper. I just want to go over this again because I think it's a great analogy, and the viewers need to focus their minds on this a little bit. So, Vietnam War, it's a land war, it's a traditional war. The demand for copper is so huge, you've got people stealing, prices skyrocketing, people stealing copper pipes out of plumbing, etc. Flash forward to 2011, there's now a currency war, there's a financial war going on. These countries are throwing derivative bombs or derivative warfare at each other, but the effects on the level of copper and silver and precious metals is the same. Because effectively what they have done is they've created the same kind of economic duress that one sees in any kind of a war, except here it's almost like they're using bombs where you don't see the physical effect. It only affects the economy. So it's these bonds, not bombs, are affecting the economy and causing prices to skyrocket as if there is an actual land war going on, correct?
Yep. That's correct. Instead of a military overhead, we have a financial overhead. And they're both forms of overhead, not part of the economy. But the problem with national income accounting is it treats everything that makes money or costs money as product. That's what makes today's national income accounting in the Chicago School so different from the classical economics of Adam Smith and John Stuart Mill and all of these people whose central distinction was between productive and unproductive investment, productive and unproductive credit. This whole distinction between productive and unproductive doesn't appear in today's economic models.
That's all the time we have actually today, but I want to thank you so much for being on The Edge, Dr. Michael Hudson.
It's always a pleasure, Max.
All righty, and that's going to do it for this edition of On the Edge with me, Max Keiser. And I want to thank my guest, Dr. Michael Hudson, author of Super Imperialism and other fantastic works. If you want to send me an email, please do so at ontheedge@presstv.com. Until next time, this is Max Keiser saying bye, y'all.